Chapter 9 will talk about what I call property, plant, and equipment, as well as other long-term assets. So the first thing is going to talk about the plant assets. So plant assets are something, again, that has a physical substance, like a big piece of equipment, a truck, computers would be office, related plant assets. So they're used in the operations of the business. They're not selling those out to make revenue. I mean, again, they could sell it at the end of the life, but that's not what they're in business to do. And again, they'll be used up over time. So a car only lasts for so many years or so many miles. And again, we refer to those as the property, plant, and equipment. Sometimes that's abbreviated PPE. You may see that. So we follow GAAP. We use our historical cost principle. So the only thing that we are allowed to capitalize or charge as an asset are the expenditures that are necessary to purchase the asset, as well as to bring it to our intended use. So we may have to make modifications, we may have to pay extra delivery costs, things like those can be added to the cost. So here they give us a list, so obviously the price to purchase it. If there was closing costs related to attorney fees or title searches, and this is showing us land or real estate. If there was broker commissions that we had to pay, any property taxes or liens that we assumed from the seller, all of those could be included in our land. So then here's an example: cash price of the land, less some costs that we needed to get it ready for our intended use. So if there was an old warehouse there that we needed to tear down, we can capitalize those costs. We must have gotten some sort of salvage value for the whatever we tore down, the lumber or whatever it was. Again, the attorney's fees and the broker fees. And then here's the entry. So we would debit land, which again is a long-term asset, and then we would credit our cash. Land improvements are things that are in the land itself that cannot be removed without damaging that land. So examples are driveways, parking lots, fences, landscaping, an in-ground pool, in-ground sprinklers, anything that's again, that can't be just picked up and moved. And those would be, the difference though is they go to an account called land improvements. And what's the key difference is what this last bullet point says. When we purchase land, we do not depreciate it because land does not get used up. It lasts forever. Land improvements like parking lots and sidewalks and fences, those do get used up. So we do depreciate those over their estimated useful lives. Then we get into, again, our plant assets, buildings. So all costs associated with purchasing that building, the purchase price, the closing costs, the real estate broker's commission. If we have to do any major repairs and remodeling to get it up to the level that we need it in order to use it. Then we can also have buildings that we construct. So if we are building that building, we will have obviously the costs associated with building it, but also architect fees, building permits, excavation costs. We can even capitalize some interest that we pay during the construction. So here is again a list of some common costs that would go into equipment. So we've got the purchase price, sales tax, freight charges to get that equipment on site, any insurance that would be paid during the in-transit time frame, and then if there's any costs to get it set up, so assembling, installing, testing, whatever's necessary for us to have it to the point where it's ready to be used. So here's an example of a delivery truck. So they purchased the truck for $22,000. They pay sales tax of $1,320. So you can see down here that's getting added to the capitalized cost of this truck. They've painted it and lettered it, again, to be used for the business. So that's also going to be added to the value. The vehicle license is used up. That doesn't add to the, every year you have to get a new ticket for your car. So that is just going to be an expense. And then obviously every year you have to have insurance. So that's nothing that was needed in order to get it set up. It's costs to maintain the truck on a go-forward basis. So these two would be expensed. and these two would be capitalized. So you have to look at the cost that way and think, is it a cost that I'm going to incur all the time just having this asset or this truck? If it is, then those are maintenance costs or expenses. So then that's what this next slide talks about. So just our ordinary repairs are going to be expenditures. So those do not add value, or they do not add life to the asset. They maintain it, and they keep it in its current condition or in good conditions. So those are going to be expenses, maintenance and repairs expense. And again, they would offset our revenues. If we have major improvements done to it that actually increases its capacity or increases its useful life, then we would allow those to be capitalized, but again, it has to increase the useful life of the asset. Then we get into what you really want to be able to compute, and that is depreciation. And depreciation is when we capitalize an asset, it's going to be on our balance sheet. So we have to show that it's getting used up over its service life. So how do we do that? We do that through our depreciation entries. So then we'll look at that asset, and there's going to be 3 different ways that we can depreciate it. But that depreciation is charging the cost of that asset off to expense over its useful life, or it's useful. It's how it's producing. So here's a kind of a table that kind of shows you that. Again, here's the brand new truck with all the costs necessary to get it to its intended use. Then slowly over time it's going to go downhill. So we're using it up here. We're charging off the costs to depreciation. We're charging any repairs and maintenance to expense. Then at the end of its life, it will have a salvage value. We can sell it or we can trade it in, and what is that value? And that's also called our residual value. So our salvage value or our residual value are the same thing, and those can impact our depreciation computations. And then depreciation, as we go into our journal entries, you're going to see that we charge it to expense, again, because we're using up the costs associated with that equipment. But the credit goes to accumulated depreciation, and that's a contra asset account on our balance sheet. It's effectively reducing the value of that asset. So here are the 3 methods that you want to understand and be able to compute, and we'll talk about each one of them. Our straight line method, our unit of activity method, and our double declining balance. So here we have an example of a truck that cost $13,000. Its expected salvage value or residual value at the end of its life, they think they can sell it or trade it in for $1,000. It's estimated to have a useful life of 5 years, and it's estimated to have 100,000 miles. So we'll depreciate this based on our 3 different units. So the first one I always think is the easiest one, the straight line method. You just take your cost minus your salvage value, so this is what's depreciable, and then you take that and divide it by your service life. So if it's $12,000 that is going to get used up over the life of this truck, divide that by the 5 years, we're going to depreciate $2,400 a year. So here it shows you again, the table almost makes it seem more complex than it is. It's just the depreciation expense. Now accumulated depreciation builds. So every year we're going to increase that by the $2,400 that we expense. Our book value is our total cost minus our depreciation is going to give us our book value. And then at the end of the life, the book value should equal the residual value or the salvage value. And then here's our journal entry. We debit depreciation expense and we credit accumulated depreciation. Then our next method is our units of activity. So in this particular one, it's a truck and it was in miles. So those are our units of activity or miles. And then we're going to look at it based on how many miles it uses up a year. So the first step is to figure out, well, what's our rate that we're going to, our rate per unit of activity. So if our depreciable cost, the cost that we're charging off to expense over the life is $12,000, we estimate we're going to drive this truck for 100,000 miles. We are going to charge to depreciation expense 12 cents for every mile that we drive. So if we drive 15,000 miles in year 1, we take that 15,000 miles times the 12 cents, and that's how much we're going to charge off to depreciation. So then this table is a little bit more relevant, like it actually shows our computations. So each year here shows you the miles that are being driven. We multiply that by that 12 cents, and then this is our annual depreciation amount. And again, the accumulated depreciation works the same way, where each year you're just going to continue to accumulate it. So the 1,800 plus the 3,600 gives us 5,400. Plus 2,400 gives us 7,800. It just works like that. And then our book value is calculated the same way, where it is our cost minus our accumulated depreciation, and then we should end up with that $1,000 that's our residual value. And again, the journal entries are set up the same way. We debit depreciation expense, credit accumulated depreciation. Then the double declining balance is basically just double the straight line method. So if we go back to that straight line method, if I could go, I'll just flip back real quick. If I go back to that table where I said this stuff is almost not necessary, it does help you to build that double declining one. So if our straight line method is 5 years, that's 20% each year. So then come here to our double declining, you can see it's 40%. It's twice what straight line is. Now the one thing that's different is it starts with our total cost. So it says, okay, our total cost is 13,000. We multiply that by 40%. That's going to be our depreciation in year 1. Then year 2, our book value is going to be the 13,000 minus what we took in depreciation to come up with our beginning year book value. Multiply that by 40%. So in this particular method, this table is very useful. You really have to do it to actually figure these values out. So then now you'll take your, the next year, the 4,680 times the 40%. This becomes your new depreciation expense. Add that to last year's accumulated depreciation to get this total. And then the 13,000 minus the accumulated depreciation gives you your book value. So again, this is probably the most complicated one, but where you really have to pay attention is this little asterisk. When you get to your final year, you can't just do the 40% times the amount, because you need this book value at the end of the service life to be $1,000. That's that salvage value. So this is more of a plug number. It isn't this multiplied by that. It's how much can I still depreciate and have $1,000 left. But then the journal entry again is the same debits and the same credits. And then this shows you again, because it's the same piece of equipment, depending on which method we use, you can see the difference in each year of how much depreciation is being taken. The consistency is that over the 3 methods, we are only depreciating $12,000 total. It's just how much are we doing each year. And a lot of times you think, well, who cares? Why do we even care about these different methods? It really goes back sometimes to the taxes. But the IRS does not require them to use the same method. So, but sometimes they might want that expense up front so that they have a lower net income in those first years, and then they're paying less taxes. But they can choose a different tax method of depreciation. And you'll talk about that in your tax class. All right, then we get into, okay, now we're at the end of the life of these assets and we are selling them. So what are the 3 ways that we can sell them? We can retire them, which means we're just pitching them. We can sell them, where we're selling them to another party and we're getting money, or we could exchange it. Now we will not cover the exchange side because that's very rare. I mean, how many companies are bartering with assets? It doesn't happen that often. So we really want to just focus this. I feel like the sale one is probably the most important. So the sale one, you want to first figure out, okay, what's my book value of the asset? So my book value of the asset is my cost, what's on my balance sheet, less my accumulated depreciation. So then we look at how much are we selling it for compared to how much do I have it on my balance sheet. If I'm selling it for more than that value, I'll have a gain. If I'm selling it for less than that value, I will have a loss. So Here we have an example. They're selling office furniture for $16,000. It originally cost $60,000 and has accumulated depreciation of $41,000. So then I'm going to subtract those. So $60,000 minus $41,000 gives me a $19,000 net book value. During depreciation, well, okay, so I still have to add one more step in there. So my depreciation for those first 6 months that I had it is $8,000. So I'm going to increase my accumulated depreciation. So first they're having us do that entry to record the depreciation up to the date of sale. So depreciation expense $8,000, accumulated depreciation $8,000. So that takes my accumulated depreciation up to $49,000. So then now I take, again, I subtract that from the cost to say my net book value on the date of the disposal is $11,000. I'm selling it for $16,000, so I have a $5,000 gain. Now the entry, again, focus on it because it might be a little confusing. You've got to make sure you take the equipment off of the books at the historical cost and then take the accumulated depreciation off of the books at what you just brought it up to, that $49,000. And then we receive the cash, so our cash comes in at $16,000, and then the difference to make this entry balance is that gain. Now the reverse could be true. Maybe we're going to get less money. So now it's the same scenario. We still have a book value of $11,000, but we're only selling it for $9,000. So you can see that the two entries here are the same. We still have to take it off of our books, get rid of the equipment at the historical cost, take off the accumulated depreciation. Now our cash amount is lower, and then instead of having a credit to make this entry balance, we have a debit, and that debit will go to loss on the disposal of the plant assets. If we just get rid of it with no gain or loss, we're just going to take it off our books. So we're taking the equipment off the books, it's fully depreciated, but you still need to remove it because you don't want your, you don't want it included like in your asset list if it's an asset that you pitched, these computer printers. Okay. Now, if it's an asset that that's fully depreciated, that we're not pitching, that we're not getting rid of, then obviously, yes, we leave that on our balance sheet because it is still an asset that we're using. Okay, then we have one now that we're pitching that we actually lost money on. It was not fully depreciated. So the equipment is $18,000. We've only depreciated $14,000. So then we're going to have a loss on the disposal of $4,000. And those, the gains and losses go in the other expenses and losses section of the income statement. Okay, then we get into intangible assets, and natural resources. So you could work at an oil and gas company. I worked at an oil and gas company for many years. And that, instead of depreciating a natural resource, it's depleted. We use depletion to do that. But we're still going to basically do the same thing where we're trying to take the cost and charge it off to expense over its useful life. If we're depleting it, so like at the oil and gas company, we had natural gas wells. As we pull that well, if we pull that natural gas out of the well, it's being used up. There's only so much in the well itself. So then we would come up with a cost. In our case, it was per MCF, and then we would charge that off every year to how much MCF that well produced. So again, you would take your total cost minus any residual value if you had any, and divide it by how many estimated units that you think you're going to get. So in this case, they're doing coal. So they have $5 million invested in this well. Normally in these kind of things, like with our oil and gas wells also, you plug them at the end, so there's normally no residual value at the end. So in this case, same thing. There's no residual value after they've mined all this coal. There's not going to be anything left. So you take the 5 million, divide it by the million tons of coal they expect to get. They're going to charge out $5 per ton. So here, if we extract 250,000 tons of coal that year, our depletion expense is going to be 1,250,000, and then we At the oil and gas company, we charged depletion expense, just like you would depreciation expense. We had an expense called depletion. This one must be done a little bit differently, so it's going into the inventory and crediting accumulated depreciation, and then maybe then they include that in their cost of goods sold. So that would be unique to the industry. Intangible assets are ones that you can't touch. You can't touch them, you can't feel them, you can't pick them up and move them, but they still have future revenue potential to the company. So like patents, copyrights, goodwill, trademarks, franchises. And then what we do is we amortize out that expense over their useful life. Now, instead of having an accumulated amortization account, we just credit that intangible asset directly. So that makes it a little bit different than what we do with depreciation. So here we have a patent example. Patents have, they protect the creator of that patent for a period of 20 years from the date that you receive the grant. Now, they may not use that as their useful life. I mean, the patent maybe won't really be used for a full 20 years, even though it's protected for that time. So they may use something shorter than that. R&D stands for research and development costs. If they have research and development costs, those are expensed as incurred. But if they purchase a patent, that's with the cost that they can write off. So in this case, they purchased the patent for $60,000. They have an estimated life of 8 years. So that amortization expense is going to be $7,500 a year. Now in this case, they're just doing it they're making the journal entry for a 6-month period. So that's why they're taking the 6 divided by 12, or 50% of it, charging that off to amortization expense. And again, you can see just reducing the patent. It doesn't go to accumulated amortization. It just reduces whatever intangible asset it is. And then here, copyrights are protected for much longer, the life of the author plus 70 years. And again, that's probably not how long you're going to amortize it, but you can amortize that cost over however long you think it's going to produce revenues. Then this gives you some examples of trademarks and trade names. And those are going to be ones more that, again, that you purchase. So if you acquire them, you can capitalize those costs. You do not amortize those. Franchises will be, again, you pay like hundreds of thousands of dollars to get this franchise agreement, and that too will be amortized over its useful life. Goodwill is an intangible asset that has to be purchased. So basically, if you purchase goodwill, it's like you're acquiring a company, you're purchasing that company. If people can create their own goodwill, but you can't value that as an asset. It has to be purchased. So whatever that, and then there is a computation to that where you're saying, okay, if I'm buying a business and I have all the assets appraised, and let's say those are $500,000, but I'm paying $700,000 to buy this asset, that would insinuate that there is $200,000 of goodwill. That goodwill is the excess of the cost over the fair value of the net assets that I'm purchasing. And the reason I would pay that is maybe because this business is in existence, it has great employees, it has great customer relations. I'm going to just step into this business and be able to run it. So I'm willing to pay more, and I could set that up as goodwill. And then goodwill is not amortized on our financial statements, but if we're a publicly traded company, the auditors will review it every year to make sure that it has not been impaired. If it's been impaired, then that would be expensed off. I mentioned R&D costs, research and developments, back with that patent, but these expenditures can lead to these different intangible assets, but they are expensed as they're incurred. Okay, then the property, plant, and equipment, we have one ratio to look at on these. So here they're showing you the balance sheet. So again, our long-term assets are here under the property, plant, and equipment. Our intangible assets are listed here. And the computation, the ratio that we use to look at that is our asset turnover. So it's your total average assets divided into your sales. So how many times are you turning those assets over? So in this case, it's 0.56 times. And again, if it all depends on the industry, if that's good or that's bad. The higher the turnover, the more efficient the company is using its assets to generate sales. Okay, so that is our chapter on long-term assets.